In the late 1990s, a school teacher in Texas started putting a small amount of money into a handful of technology companies every month. He wasn't a Wall Street expert. He didn't have insider information. He wasn't trying to get rich quickly. In fact, most of his coworkers thought he was wasting money. The stock market had already gone up. Technology companies seemed expensive, and many people believed they had already missed the opportunity. But over the following years, that ordinary teacher watched those investments multiply far beyond what he imagined. What made his story remarkable wasn't that he invested in technology. Thousands of people did. What made it remarkable was that he recognized something most people couldn't see. He understood that major wealth-building opportunities often look uncomfortable while they're happening, and that's exactly why most people miss them. Today, many investors are asking a similar question. What if we're witnessing another one of those rare periods in history? What if the conditions that created thousands of everyday millionaires in the past are beginning to appear again? Not because history repeats exactly. It doesn't. But because human behavior does. The same emotion, the same skepticism, the same fear, the same tendency to underestimate how much the world can change over the next decade. And if that's true, the biggest financial opportunity may not belong to experts. It may belong to ordinary people willing to understand what's actually happening before everyone else accepts it. Because the last time this happened, a surprising number of regular people became millionaires. And the reason goes much deeper than stock prices. It starts with a pattern that has repeated itself throughout modern economic history. A pattern that most people only recognize after it's already over. The pattern begins with a breakthrough. Not a company, not a stock. A breakthrough. Something appears that fundamentally changes how people work, communicate, produce, or live. At first, almost nobody understands its significance. Then, early adopters begin using it. Businesses slowly adapt. Skeptics dismiss it. Experts debate it. The media alternates between excitement and criticism. And during this period, enormous wealth is often created. Not because everyone becomes rich. Most don't. But because ownership becomes incredibly valuable when an innovation transforms entire industries. We've seen this happen repeatedly. Railroads, electricity, automobiles, computers, the internet, smartphones. Each innovation changed how society functioned, and each created opportunities that looked obvious only in hindsight. Consider the internet. Today, it's difficult to imagine life without it. But during the early years, many people viewed it as a niche technology, something interesting, maybe useful, but not world-changing. The reality turned out to be very different. The internet didn't create one industry. It transformed hundreds. Retail changed, advertising changed, communication changed, entertainment changed, education changed, finance changed. Entire business models emerged that previously couldn't exist. And because of that transformation, ownership in the companies driving those changes became extraordinarily valuable. But here's the part most people forget. The opportunity wasn't obvious at the time. The future rarely is. When people look back at successful investments, they often imagine investors confidently predicting exactly what would happen. In reality, uncertainty was everywhere. There were crashes, scandals, market panics, economic downturns, competing technologies, failed companies. Nobody had a perfect map. They simply recognized that a powerful shift was underway. And that's where the psychology becomes important. Because wealth-building opportunities are often less about predicting the future and more about understanding human behavior. Behavioral finance researchers have spent decades studying how people make financial decisions. One of the most consistent findings is that humans struggle to think exponentially. We're naturally wired to think in straight lines. If something grows by 10%, we expect another 10%. If technology improves, we imagine gradual improvements. But transformative innovations often grow exponentially. And exponential growth feels slow at first, then suddenly appears explosive. Imagine a pond with a single lily pad. Every day, the number of lily pads doubles. 1 becomes 2, 2 becomes 4, 4 becomes 8. For a long time, the pond looks mostly empty. Then, seemingly overnight, it becomes completely covered. Most people notice change only after it becomes obvious. Investors often behave the same way. By the time an opportunity feels safe, much of the wealth creation has already occurred. This psychological tendency has appeared repeatedly throughout history. People underestimate major changes because they judge the future based on the present. But transformational periods don't work that way. The future arrives gradually, then suddenly, and that's exactly what creates opportunity. Yet there's another reason ordinary people often miss these moments. They focus on price instead of ownership. This distinction sounds simple, but it changes everything. Imagine two individuals. The first person constantly asks, "Is this investment expensive?" The second asks, "What could this asset become if the underlying transformation succeeds?" The first focuses on current conditions. The second focuses on future possibilities. Neither approach guarantees success, but historically, the greatest fortunes have often been built by people who understood the difference. Because when society undergoes major shifts, today's prices can look insignificant compared to tomorrow's outcomes. Again, this doesn't mean every new technology creates wealth. Far from it. Most innovations fail. Most companies disappear. Speculation destroys fortunes every generation. But when a genuine transformation occurs, ownership matters a lot. The numbers reveal something surprising. Research from several market studies has shown that a relatively small number of companies account for a massive portion of total stock market wealth creation over long periods. In other words, extraordinary winners often drive extraordinary results. This means wealth creation isn't usually evenly distributed. It's concentrated. And that's why identifying major trends matters. Not because every company succeeds, but because a few can reshape entire industries. Now let's connect this idea to something happening today. Artificial intelligence. Whether someone loves it or hates it, AI has already moved beyond theory. Businesses are implementing it. Employees are using it. Entire industries are restructuring around it. Productivity tools are changing. Software development is changing. Healthcare applications are expanding. Financial analysis is evolving. Customer service is being transformed. And the technology continues improving at an astonishing pace. But here's where things become interesting. The opportunity may not be AI itself. The opportunity may be everything AI enables. The internet created far more value than web browsers. Electricity created far more value than light bulbs. Automobiles created far more value than car factories. Transformative technologies often generate second-order effects that become even larger than the original innovation. This is where many investors make mistakes. They focus only on the obvious winners, but history suggests the biggest opportunities frequently emerge from businesses built on top of transformative platforms. Think about how many industries were reinvented because of the internet. The same principle may apply again. No one knows exactly how. No one knows which companies will dominate, but the broader pattern is familiar. A foundational technology appears. Capabilities improve rapidly. Adoption spreads. Entire industries evolve. And ownership becomes valuable. Yet, even if this pattern unfolds, most people still won't benefit. Not because they lack intelligence, because of behavior. The greatest obstacle to wealth creation has rarely been access to information. Today, information is everywhere. The obstacle is emotional decision-making. Let's imagine two investors. Both understand the same opportunity. Both believe in the long-term trend. Both start investing. Then the market falls 30%. The first investor panics. News headlines become frightening. Social media becomes negative. Friends become pessimistic. The investor sells. The second investor views the decline differently. Nothing about the long-term transformation changed, only sentiment changed. So the second investor continues investing. 5 years later, their outcomes may be dramatically different. Not because one was smarter, because one managed emotions more effectively. This concept is supported by decades of behavioral finance research. Studies consistently show that investor returns often lag investment returns. Why? Because people buy when excitement peaks and sell when fear dominates. They chase performance. They react emotionally. They interrupt compounding. Compounding itself is one of the most misunderstood forces in finance. People hear the word constantly, but few truly appreciate its implications. Imagine investing $500 per month consistently. Nothing exciting happens initially. The portfolio grows slowly. Progress feels disappointing. Years pass. Then something remarkable occurs. The growth generated by the investments begins producing growth of its own. The snowball starts rolling. Over time, contributions become less important than accumulated growth. This process feels almost invisible at first, then overwhelmingly powerful later. And during periods of major economic transformation, compounding can become even more significant because you're not only benefiting from time, you're potentially benefiting from innovation, productivity growth, and expanding economic value simultaneously. This is one reason so many ordinary workers became millionaires during previous technological revolutions. They weren't financial geniuses. Many simply participated consistently. They owned productive assets. They stayed invested, and they gave time enough room to work. But there's another lesson hidden beneath these stories, a lesson that receives far less attention. The people who became wealthy weren't merely investing money. They were investing in progress. That distinction matters. When people think about investing, they often imagine stock symbols and account balances. But ownership ultimately represents something deeper. It represents participation in human advancement. Businesses create products, solve problems, increase efficiency, generate value. The economy expands because people innovate. Investors benefit because they own pieces of that innovation. Viewed this way, investing becomes less about speculation and more about alignment. You're aligning your financial future with society's productive future. And historically, that has been an extraordinarily powerful strategy. Now, does this mean everyone watching this video will become a millionaire? Of course not. Financial success depends on income, savings rates, discipline, time horizon, and countless other factors. But history does suggest something important. Periods of technological transformation tend to create opportunities for ordinary people who position themselves correctly. Not because they predict everything perfectly, because they participate. Consider what often happens during these moments. Many people spend years debating whether the transformation is real. Others spend years waiting for certainty. Others focus entirely on short-term market movements. Meanwhile, a smaller group quietly accumulates ownership and remains patient. Eventually, the transformation becomes undeniable. At that point, participation becomes expensive. The easy gains are gone. The uncertainty disappears, but so does much of the opportunity. This is why some of the greatest investing advice sounds boring. Invest regularly. Stay diversified. Think long-term. Control emotions. Remain patient. People dismiss these ideas because they lack excitement. But history repeatedly shows that boring principles often produce extraordinary outcomes. The challenge is that they require something many investors struggle with: delayed gratification. Modern culture rewards immediacy. Instant purchases, instant entertainment, instant feedback. We become accustomed to quick results. Wealth creation operates differently. The largest rewards frequently belong to those willing to wait. And waiting is psychologically difficult, especially when everyone around you appears to be moving faster, especially when markets become volatile, especially when uncertainty dominates headlines. But this is where the difference becomes clear. Wealth isn't merely about identifying opportunities. It's about remaining committed long enough for opportunities to mature. And that brings us back to the title of this video. The last time this happened, lots of regular people became millionaires. Not because they discovered a secret. Not because they were born wealthy. Not because they possessed extraordinary intelligence. Many simply recognized that the world was changing. They acquired ownership in productive assets. They remained patient through uncertainty, and they allowed time to magnify their decisions. The next wave won't look identical. History never repeats perfectly. The companies will be different. The technologies will be different. The headlines will be different. But the underlying pattern may be remarkably familiar. A major transformation emerges. Most people underestimate it. Fear and uncertainty dominate early discussions. Adoption expands. Economic value grows. Ownership becomes increasingly valuable. And once again, ordinary people have an opportunity to participate. The question isn't whether another transformation will occur. Human history suggests it will. The real question is whether you'll recognize it while it's happening. Because the most important lesson from every generation of wealth creation is this: millionaires are rarely created when opportunities become obvious. They're often created when opportunities still look uncertain, when the future remains unclear, when skepticism remains widespread, when patience is required. And perhaps the greatest financial advantage isn't predicting exactly what will happen next. It's understanding that progress has always rewarded those willing to own a piece of it. Years from now, people may look back on this period and say the signs were obvious. They'll point to the innovations, the adoption curves, the economic shifts, the investment opportunities. Everything will appear clear in hindsight. But that's the illusion of hindsight. The future never feels obvious while you're living through it. That's why wealth building is ultimately less about forecasting and more about perspective. The people who benefit most from transformational eras are often the ones who understand a simple truth. You don't need to know exactly how the future unfolds. You simply need to position yourself so that if progress continues, you participate in the upside. Because when history's next great wealth creation cycle arrives, and perhaps it already has, the biggest winners may not be the loudest voices, the most confident experts, or the most aggressive speculators. They may be ordinary people who quietly recognize what previous generations eventually learn, that the greatest opportunities often appear before the crowd believes they're real. And by the time everyone agrees, the millionaires have already been made.